All right, guys, welcome to We Talk Money. Today is Friday, January 30th, the last trading day of the month. And as of right now, we've got metals that are finally crashing. If we pull up the chart, silver is down like 25% on the day. And gold, as of right now, is down a little since the highs of yesterday. It's down almost 10% on the day, but since the high of yesterday, it's down 13%-ish. And we've also got Bitcoin that, as of today, broke kind of this key support area I've been watching. We've got a ton of stuff to cover because it's been well over a month since our last show. Let's all take a deep breath. And man, we've got a ton to talk about.
I know. And first of all, really quickly, where the hell did January go? The new year was here, and then it's like, shit, we're already going into February.
Yeah. I was like, we cannot let January go without a show. There's just so much going on. And we've been obviously busy as hell over here with the community. And we launched the new newsletter, the Escape Velocity Investor. And yeah, Trav, I don't know, man. Just take us into this conversation. Let's start with the whole gold, Bitcoin, dollar debasement trade idea. Like, that's where a lot of eyeballs and focus are on right now. And with metals pulling back, the big question is, well, is that capital going to rotate into Bitcoin, or is the 4-year cycle going to dominate? There's so many questions out there. I can almost predict the questions that our listeners and viewers are going to ask. So yeah, just lead us into that combo, Trav. Where are we? What's going on? And tell us exactly what the markets are going to do over the next 3 weeks.
Yes, let me consult my crystal ball.
Yeah.
So first of all, I'd say you're right. Like, it has just been a deluge, a absolute flood of headlines and information this week in particular, certainly this month, but this week in particular. Like, it's like one of those weeks where we say, like, like nothing can happen for a long time, and then all of a sudden it's like decades happen in weeks. It's one of those weeks. So yeah, we have had just some incredible moves across asset classes. You mentioned the big one has been gold and silver. Metals have just been on fire. One of the strongest groups, not just on the metal side and commodities, but also on the stock side. A lot of the mining stocks have just been going parabolic. I think I tweeted something earlier this week that basically investing becomes so much more easy if you have a timeline that's more than, weeks or more than days, because a lot of people have been saying like some really crazy things with the rise in metals prices. It's like, why is Bitcoin not joining in the party? Why don't you own more gold and silver? Like, the US dollar's being debased constantly. And like a lot of this stuff, like the debasement idea, have been true for many years. And so to me, a lot of what's happening in metals is just a pure momentum trade. And we're seeing momentum become such a dominant strategy, not just in stocks, but now in commodities, in crypto certainly as well. It's like momentum is like the flavor of the day. And so when you're hot, and everybody's talking about you, and everybody wants to own you, and everybody's grandma's all of a sudden asking, should I buy gold and silver, right? And then you can flash forward a month and it's a completely different thing. And we're seeing today with the 25% move, down in silver, it's like, this is just pure momentum. And momentum has massive shocks. Like, if you go back and you study the data on momentum, study the academic papers that have been done on all these different asset classes for the momentum strategy, what you find is that there's these historic massive shocks to these momentum trades, because it's like everybody piles in, and then guess what happens? They get crushed. And it's just a classic pattern that we see in markets. And so that's why I said, like, if you can have a time horizon, if you can have an independent thought in your head that's not just chasing whatever's hot at the exact moment, then investing becomes so much easier and so much less chaotic. You think about, what do I want to own? What are the fundamental principles that I believe in, right? And so, like, with something like US dollar debasement, which I want y'all to talk about more here too in a second, I think we've long said that is one of those trends you can count on. The US dollar basically losing its purchasing power over time has happened almost every single year for the last 75 years. It's one of those things you can count on, right? And so there are things like that in investing, right? Own productive assets, own cash flowing assets. That's why we are involved in stocks. And so if you step back away from the daily crazy price action we're seeing, I think it's really important and helpful to think about, like, what are your key principles? What are your key investing strategies? How do you avoid just chasing whatever's hot and then getting blown up, when you have a day like today with a 25% down move? So it's really important. It's really important to have that grounding, so to speak. And then you can go and make better decisions for your like long-term portfolio returns. And so, in weeks like this, it's ultra important to know like what your principles are, what your investing strategies are, and then how you're going to tactically go and actually put that into practice.
Well said.
That's important because a lot of people right now, I've talked to a lot of people that are feeling FOMO about this gold silver, trade, and they think that this is just going to keep going forever. And this, momentum in 2021 was huge, right, Trav? We were there for that. And we saw a lot of these names just get chased into oblivion, into the stratosphere. And we see what happens when, momentum turns. And so I think that you made a lot of really great points. And if anyone out there is feeling that FOMO, you have to remember that a lot of the smart money is probably selling up here, or, they plan to sell if they haven't already sold. This is not where piling into gold and silver makes fundamental sense. And of course, we all could be wrong, and maybe the dip gets bought and this thing just keeps going and going and going, right? But you have to think about risk to reward when you get into these scenarios.
Yeah, and we have a lot of things kind of coming together at the same time this week. One, we had the Fed interest rate announcement, which was kind of a nothing burger, but it also highlights the point that we are at a kind of a crucial decision point. Like, are we going to keep, dropping rates, which is going to have its own implications, or is inflation going to heat up again? Also today, Trump just named his new Fed Reserve Chair, which... Trav, do you know much about Kevin Warsh?
I don't know a ton, but he's been floated as a potential Fed chair a number of times in the past couple of years, and even in the Trump's first term. So, I've read up a little bit on his views and kind of watched a few of some of his videos and kind of thought through, what his core beliefs are. But I'm certainly not an expert on the guy, and it's confusing too because I think his views have changed over time. And so, he was always seen as a more hawkish member of the Fed,
right?
When he was part of the Fed board, a decade ago. And so, he was always, we need to fight inflation, even if it hurts the economy. We need to prioritize Main Street over Wall Street. And those were his core views. But it sounds like a lot of that may have shifted over time. And also with Trump appointing him, we probably have to believe that, Trump's had those conversations with him about wanting to get interest rates down, being sympathetic to Trump's own views on what the Fed should be doing. And so I think there's a lot we don't know, and we won't know until we get him in as chair.
Yeah. And here's Nikki, you shared this with us. It's a document from the Informationalist, I think is what it's called. But it's basically like just explaining the debasement trade. And the subheadline is why gold is the signal and Bitcoin is the ultimate beneficiary. And he starts by talking about what the problem is and basically the big impossible choice that the Fed has. And on the left here, you can keep rates high, which causes the interest expense on the debt to spiral out of control. Deficits can explode, growth stalls, tax revenues decline. And, it's just like a fiscal crisis leads to more forced printing. On the other side of the coin, you can cut rates and do QE. This can reignite inflation. It continues to erode the power that the dollar has. It gives negative real rates. Savers get destroyed, right? People that aren't investing, they get punished. And, you basically pay the debt with cheap money. And the result there is more currency debasement by design. And Trav, I know you created this chart that basically shows how the dollar has lost 90 something % of its purchasing power since 1950. And you can see how a dollar back in 1950, is now only going to get you about 8 cents on the dollar of actual purchasing power. Now, again, wages have gone up, markets have gone up. So, you're very unlikely to have the same in 1950 as today. But I think if we look at just from, 2019 to where we are at the end of, or where we were at the end of 2025, the dollar lost around 20% of its purchasing power from the trillions that were, printed throughout the COVID era. So this is a really important question to ask and look at right now. And a lot of people that haven't really been on the professional investor side or in our world, they're starting to think about this stuff and ask these questions. And it's got a lot of people thinking. And, something I'm seeing floating around a lot this week specifically is the whole idea of the dollar losing power around the world and what happens to the US and US markets and really the global economy if the US dollar is no longer the world reserve currency. And then, Nikki, a tweet that I wanted to show that you shared with us is showing how the percentage of world reserves held in dollars has been coming down over the past decade, and gold has dramatically gone up. So I think one of the driving factors behind the price of gold has been governments actually stockpiling gold as well, and more repressive regimes putting currency controls and controls on physical metals like silver and gold. So yeah, I'm just covering a lot of this stuff, but where does this put us, or what questions does this bring up, or what conclusions can we come to from all this?
I think page 16, Chris, there's an interesting chart visualizing or a picture visualizing central banks buying more and more gold. So clearly, the question is why, and there's probably multiple reasons, but there's speculation that it's because of these fears, right? These fears of the fiscal spending, what are their choices? Their choices don't look great, especially in today's environment where people are now concerned about inflation reigniting if they lower rates next year even more. I don't know if that is a valid concern yet or not, but I think it begs the question, why is Bitcoin lagging so much? Because when I read this paper, it really was a strong case for, I was like, we need more Bitcoin. Like, we need to buy more Bitcoin. That was my immediate thought after I read this paper. And a lot of the points made, it was more so that there's a perception lag. So essentially, Bitcoin is seen as a risk asset, not necessarily, a debasement hedge. It used to be seen as that, I thought, or it's gone through these phases. I feel like people have been, oh yeah, Bitcoin, debasement hedge, gotta own it. Fiat sucks, right? And then it goes to just being a risk asset like any other risk asset. But of course, equities have been flying high, making new highs. So what the hell is going on, especially with gold going parabolic? Why is Bitcoin lagging so much? And when I went through some of the reminders of basically their cases, Bitcoin is the hardest money. It's even, harder money than gold for these specific reasons. It's got absolute scarcity, right? There's only 21 million done. No other, like, that's it. There no mining. And then portability, which I think is actually a really strong it's a really big strength of Bitcoin is the portability, and then seizure resistance. So what stood out in my mind was the portability and the seizure resistance. And I was like, holy crap, like that, those are really strong cases for why Bitcoin would be even harder money than gold. And so I don't know, when I was reading through this, it kind of reminded me of why Bitcoin has held up all of these years and why it hasn't completely collapsed like a lot of people predicted it would. And as far as the lag, I think I agree with what they're saying, that it's a perception lag, and maybe people are kind of forgetting what Bitcoin is and what it can do and why it's gotten to where it is today and hasn't died yet. Yeah. So yeah,
those are great points, and everybody wants to look for a single reason, but there's a few things going on here at the same time. We've got the 4-year cycle, we've got central banks that are accumulating gold, and governments that are accumulating Bitcoin, maybe just at different paces, and they don't all happen at the same time. But to your point about the benefits of gold over Bitcoin, I think it's a really important reminder, right? Absolute scarcity, because what happens when the price of a commodity, be it gold, silver, oil, whatever, when that goes up, what do producers do? They increase the supply. They go out and they mine more gold. And we don't know how much gold is really out there. It's somewhat finite, but we don't actually know what the cap is. With Bitcoin, it is exactly 21 million. With portability, we've talked about this example in the past, of, let's say you're a Chinese billionaire and you're trying to get the hell out of China. Yeah, good luck getting $1 billion worth of gold out of China, where if you remember 12 or 24 words in a row, your seed phrase, you could technically have access to $1 billion worth of Bitcoin on the blockchain that you could fly around the world, have that stored in your mind, and nobody knows about it. Right. And then seizure resistance. Here's another important thing that actually highlights this point today. Balaji had a really good thread today. I think he posted it today, where he talks about, just gold and Bitcoin and some of the pros and cons. And then right below that, just 3 hours ago, he goes, like clockwork, Russia is banning the export of 100 plus grams of physical gold, about $17,000 today at current prices. Expect more states to follow, first with bans and then with seizures if the price really soars. So, seizure resistance, absolutely a huge one. So, and Nick, to your point about the perception of Bitcoin as like, what is it? Is it a risk asset? We've seen times like last time Trav and I were in Bali, Trav ran the numbers and we were like, oh, these are actually Bitcoin is inversely correlated with stocks. And then it's like in recent years, it's been very, very correlated with stocks. So it's like, is it a risk asset? Is it a debasement hedge? I think the answer is yes to like all those. It has been those, and it's still evolving and changing. And there's still the whole idea of the 4-year market cycle, which I think is kind of a self-fulfilling prophecy and has been our base case for why 2026 could be a bear market. So we'll jump into the charts too. But Trav, anything you want to add to that?
Yeah, I mean, there's a couple different angles there. But one thing I would say, we talked about this a little before the podcast, but I want to say it for our listeners. Like, I think, there's a lot of people, I think, that are missing the forest through the trees, so to speak, just looking at current price action. Bitcoin as an asset doesn't exist independent. I mean, its price action is dependent on the people that are owning it and trading it, right? And we have a totally different group of holders that have been owning and trading Bitcoin in the last year than maybe we did 5 or 10 years ago, right? There's a completely different holder profile. And so it's natural that it would evolve. It's natural that an asset like that, especially a global one, evolves in terms of how its price reacts to things, especially in the short run. And so like when people look at short run price action, particularly when markets are so dominated by algos and momentum across asset classes, I think that's where you get that missing the forest through the trees. Like if you believe just because Bitcoin has been underperforming gold or silver for 2 months in the most like hot Momo environment for those metals ever, and if you all of a sudden now say that Bitcoin's not a debasement hedge or it's lost some long-term property because of 2-month price action, again, I think you're just sort of missing the point. An asset like assets, particularly ones that are that have these properties that are supposedly going to be present over long periods of time, they can still trade like risk assets in the short run. And we've seen that from gold. We've seen that from silver. They didn't go anywhere for a decade. There was monetary debasement happening for a decade. Where were gold and silver, right? And so are you going to go out and say gold and silver are no longer, debasement hedges? No, maybe not, right? And so I think like looking at multi-week or just a couple of months of price action is incredibly short-sighted. I would also say, again, I would go back to what I said at the beginning. I think a lot of what's happened with gold and silver, like narratives often follow from price, and price action, a lot of this is just momentum chasing. And so, a lot of people have been talking, there's been a lot more talk about debasement and USD and central banks buying gold, but this has been going on for like a decade. Like China saw the writing on the wall a decade ago when the US-China relations started to break down, and they started trying to diversify more of their Forex reserves into gold. And so, they're like, I think the largest central bank holder of gold now, or maybe the second largest. And so it makes sense, like thinking from their perspective, why they would want to diversify. You saw what happened with U.S. sanctions on Russian assets, for instance, when Russia went to war. Like no one wants to be on the wrong end of U.S. Policy decisions, especially when you have like the U.S. all of a sudden, shaking up the global order, so to speak, in terms of how they're approaching the rest of the world, right? So. So a bunch of different angles we could talk about there, U.S. geopolitics, et cetera, gold, central banks. But ultimately, I think one of the biggest things is don't take short-term price action as like long-term truth. And maybe that's just me being a value investor and knowing how investors like do this in stocks and have always done this in stocks as well. Like look at the AI trade right now. It's the same thing. Like we have the memory storage players who have been going parabolic lately, and they're trading off big time today because why? Because other assets are selling off, other momentum assets are selling off. What does that tell you about the AI demand? Nothing, right?
Yeah.
So like short-term price action does not tell you fundamentally what's happening. And so I'll just leave it at that.
To your point, just like we have different capital buckets for different strategies and hold times, right? Like we've got our long-term buckets, our short-term and medium-term buckets. I also put like information and narratives in buckets as well. So when you think about the inflation ideas and Fed actions and the fact that the dollar's getting hammered over multiple decades, right? Like those I put in like the long-term narrative bucket. Like those things are true over a long period of time. In the medium term, I look at things like the 4-year cycle in Bitcoin with the halving and, market cycles and how that's been a very reliable self-fulfilling prophecy since Bitcoin's inception. And then on the shorter term, you've got things like momentum, momentum strategies, algorithms, funds, one of my managed futures funds that I invest in, they are a trend trading strategy, and they typically do really well when commodities and equities and currencies are in extended trends, right? So those things last weeks to months to maybe a couple of years. So I think that's like the short-term thing. So yeah, just because there's a true long-term narrative, I think to your point, it makes sense to not get frustrated or impatient when every single day doesn't exactly line up with that long-term narrative. Yeah.
You're here.
And silver's down 30% now, by the way.
Holy shit. All right, let's pull it up.
That has to be like a 5 sigma move or something ridiculous. There's probably some momentum or quant funds that are getting really blown up right now.
Yeah.
Some CTAs maybe that are getting blown up and blowing out of this.
Wow. Yeah. Silver futures. Let's see. It's down like 20%, but from the pivot high, because it was green this morning, it's down, over 30%. That's wild.
Yep.
Now, I do want to say, if you pull up, a chart of gold and silver and do like a % off highs to see how big the drawdowns can be, these are very volatile assets. They can have really, really steep, deep drawdowns. So I can't say I'm surprised.
Yeah. I mean, and if you look at a long-term chart of silver, let's go back to, this only, the futures only goes back to the 90s when E-minis came out. But yeah, the last time silver went parabolic from, call it $20 to 50, it took well over a decade to recover. And so that's why I've been encouraging my family to, hey, if you have silver that you've been sitting on for decades and, you could use the cash, now's probably a good time to take some chips off the table.
Because it's probably going to take another 50 years once it pulls back to get back to
it could. But here's something that I wanted to point out. Actually, there's two kind of tweet threads that I posted this week because I just wanted the snapshot in time. I was looking at earlier this week the 10-year compounded returns. So the CAGR, CAGR, for anybody that doesn't know that metric, it's looking at like what is the average return or the compounded return over the last decade, most recently after this parabolic run or kind of in the middle of this parabolic run in metals. So Bitcoin over the past decade has averaged about 70% a year, where silver 23%, the NASDAQ, so stocks or at least tech stocks, closer to 20%, and then gold 17%. Now, before this year, before metals went crazy, they were way underperforming that. And so it's basically, this year and 2025 really helped as well. But it's really just the last 12 to 24 months max that have really, really juiced the returns in gold and silver, where stocks have been more steady. And Bitcoin has also had multiple market cycles and is higher volatility. So you had to take on more risk and sit through deeper drawdowns to get that return. And somebody was commenting, adjusted for volatility, the NASDAQ barely had any drawdowns in the last 10 years. And so that sparked me to do a little more digging here and look at not just the CAGR, but also the max drawdowns, and then look at some volatility adjusted ratios that I think are important, like the Sharpe ratio, to see even taking into consideration volatility, how much reward are you getting for unit of risk? And also Sortino, and there's several other metrics that we can use for this. But Bitcoin is actually a very, very great performer, as is NASDAQ. And after this run, as is gold. Silver, not so much, because it has such parabolic rips and dips. But I think this just really highlights the importance of diversifying. This is why I say, like, hey, listen, even if you're a Bitcoin believer, I still think it makes sense to own some stocks. I still think it makes sense to own some metals, because as we're seeing now, there's going to be periods of time where metals outperform stocks and Bitcoin and vice versa. So instead of getting whipsawed back and forth and just trying to chase the hottest thing and end up buying parabolic tops, if you get in early and you accumulate when prices are down, that's where the best reward to risk ratios come in. And that's where the best long-term CAGR in your own portfolio will actually present itself, I think.
And Chris, you talked about years ago on the show, we could even pull up the receipts about, when you were accumulating physical gold, and we had talked about how gold, like historically, you look at the longer term returns and how, it's a little less correlated to some of the other risk assets. Like it plays an interesting hedge role in portfolios overall over long periods of time. So yeah, like this is this is not something we're just now talking about. Like you've been talking about this and actually putting this into practice in your portfolio. You've alerted in our community years ago that you were adding more gold to your portfolio. So like, yeah, again, that's why we kind of go back to like, what are your principles, your foundations, and like, how do you look at things when they're not like the hot asset of the moment,
Yeah. Yeah. And it's funny because even though I did diversify into gold, it was basically in between, like, I think 2014 to 2019 is when I was building my stack here. Mm-hmm. And I look at it and I still would have been better off holding Bitcoin, but it definitely does prove a point, at least over the last 12 months or so, because when you look at, gold to Bitcoin performance, Bitcoin is down on gold since the pivot high in late 2024. So again, just over a year, gold has significantly outperformed Bitcoin. But if you look at my entries, going back a decade, like, yeah, I still would be better off holding the Bitcoin, but I'm okay with that. Like, I don't need to look back in history and go, woulda, coulda, shoulda. I need to maximize every potential profit the market offers. I just want to be able to sleep well at night with my position sizes and also have some kind of hedge if and when Bitcoin does underperform. So this does help the drawdown that I'm having in my Bitcoin long-term stack right now, as does my holding in stocks, right? And so with stocks still around all-time highs, like my general net worth and portfolio is getting hurt way less than it would be if I was, say, 100% in Bitcoin.
Yeah. Interestingly, speaking about Bitcoin specifically, like there's been a pretty high correlation between Bitcoin and, of all things, some of the ARK ETFs, which I think is really interesting over the last like 6 months. So it very much has been trading like a sort of high beta tech stock. And again, we had done an analysis a couple years ago showing that it was actually at back then like inversely correlated, and so lately it's been acting as sort of a high beta tech stock proxy with apparently no AI infrastructure exposure.
Yeah.
But those things shift and those things change over time. And sometimes like the little like short-term squiggles are nothing on a long-term chart, as you just kind of pointed out. And so I think it's important for people, again, not to lose sight of the kind of the longer term picture. And also on the topic of parabolic charts, we always warn people, like, if you're getting in at on a parabolic top itself, you're putting yourself at a lot of risk. And if you're not taking profit, in the parabola, that's also risky, because you basically, probably give yourself a high chance of giving most of your gains or all your gains back. And so we're always a fan of like the scaling out strategy. And that's why, like, you're never going to nail the perfect top, especially in a parabolic market. And so you've got to be able to take some chips and be okay with not being perfect, but still making money along the way.
Yeah.
And today is just a perfect example of that. Like, if you've been super long metals, like, I hope you were taking some gains along the way. And I would say the same thing for like AI infrastructure stocks, or some of these storage stocks. Like, I know a couple of our community members were doing that successfully and kind of taking profits along the way. And I look a little stupid maybe for selling my Microns, a lot of my Micron early, but like, it's a cyclical business and it's in a parabola, and that parabola is not going to last forever. So, I bought it like an average cost of like 60, which was probably below like where 95% of the market participants bought. And so there's a lot of different ways to make money, but if you're not, you're not following that process and knowing when to take chips off, you're going to get wrecked. So yeah.
Yeah. Well said.
The question becomes,
oh, go ahead, Nick.
Oh, go ahead. I was going to ask, the question becomes, are you buying the dip in metals, in both gold and silver, one or the other, or none at all, and you're waiting for maybe a true bear to come to accumulate again?
It depends on how deep the dip is and how aggressive. Like, I look at the market cycles in phases, right? You have the early trend, which is phase one, or you have accumulation rather, which is phase one, early trend, which is phase two, parabolic rips, which is phase three. And then usually phase four is a fast crash, which is what we might be seeing right now. And then phase five is usually like choppy volatility. And so if there was a dip that I was going to buy in metals, it would be for a shorter term trade. So yeah, we'll just have to see where we end up by market close. I think, traders are kind of rushing for the exit here going into Friday afternoon. Also, close of the month, maybe there's some accounting stuff there too.
And also there's rumors out there that US could be getting involved in Iran over the weekend, which you think would be good for metals, but because they perform so strongly, again, they're kind of turning into a hot money risk asset in the short run. So it's like,
yeah,
everybody's taking chips off. Yeah.
Also, before I forget, I wanted to talk about the 4-year market cycle in a little more detail, because a lot of people are like, why is Bitcoin down? I can't possibly understand, gold's up, Bitcoin's down. The base case narrative is the 4-year market cycle, right? And we talked about this in December, I believe, going into the end of the year, where we were basically flat on the year. And then we closed slightly down. We were down like 6% on the 2025 candle. But what actually happened was, at one point from the open of the 2025 candle, we were up about 35% on the year going into like Q3 or like into the fall timeframe. And so Bitcoin was up pretty significantly, which was a third green year in a row with an anticipatory 2026 red year. Just people looking at this very simple yearly chart, 3 green years up, 1 red year down, right? And that has worked really well, more consistently than anything I've ever seen in any market ever. It's, usually the more obvious something becomes on the chart, the higher probability it has of not working. And so my whole thing going into 2026 was like, well, what's the pain trade? What could that be? But the base trade is still a red 2026 based on the 4-year halving cycle, no matter what stocks are doing, no matter what gold's doing, just based on the halving cycle. And maybe that does become a self-fulfilling prophecy, or maybe there's a pain trade where something happens fundamentally or with the narrative with the dollar where Bitcoin does catch a bid and ends up turning green for 2026. But I don't think we should be surprised that the market topped out in 2025. And if anything, it probably got a little bit front run. So yeah, 2025 was green most of the year. And then instead of like a parabolic blow off top, which comes from euphoria, what we actually got was kind of like an apathetic kind of bleed out. And so it was almost like people were anticipating red 2026. So traders and investors were like, well, let me kind of front run this a little bit. Even if I don't catch the exact top, let me go ahead and take some profit off the table, right? The other thing that happened is we hit our main profit target up around 120 to 125, which we had set this profit target back in early 2023 when the bull market started, right? Just based on technicals. We said, if we break a new all-time high, 120 is the key zone to watch. And that actually ended up holding as resistance. Did we know that was going to happen for sure? No, but that was the most likely, highest probability path for price action to follow. And it did. So that's where we are. And that's what I think is different from, 2017. We had a parabolic blow off top because there was mass euphoria. There was FOMO rush. This past year, we've also seen more competition for degen money, like Polymarket, call sheet, betting markets, AI craze, right? Think about the finite amount of people that have been buying and getting destroyed by meme coins and NFTs. Those people are just what we call in the internet marketing world, opportunity seekers, where they jump from thing to thing, they chase and they lose money in everything they go into. But initially that dumb money is what drives prices higher. And so it's gone from NFTs, meme coins, prediction markets, what else? AI stocks. There's always a new
sports
hot
gambling.
Thing. Sports gambling in kind of that same realm, right? Everybody, I would say a lot of the younger generation, Gen Z and younger millennials, have just been chasing the new hot thing because they feel like the old way of starting a business and making money, they've been sold this narrative that doesn't work anymore. And so a lot of people just chase these kind of easy get rich quick things, which sometimes you get lucky and you make a shit ton of money. And other times you're late to the game and you end up buying the top or being a little too late and losing money. So I think that's another thing, is just the competition. That's why we didn't get an altcoin season, a meaningful altcoin season this time. It's because people they've already lost money in meme coins. They got hawk to it. They got Trump coined. They lost,
I forgot
99.
about that.
Yeah, they lost 99% on their NFTs. They bought and held the top 10 altcoins that, we were making fun of these crypto influencers that were out there saying, how altcoin season was coming. And, well, we never got that over the 2.5, almost 3-year bull cycle that we've been in Bitcoin. Alts have just kind of puttered along and barely gotten there. There have been outliers like Zcash and even Monero a little bit. But for the most part, 90-something% of alts have underperformed Bitcoin. And I think the reason for that is people just got burned, man. And they moved on to other newer, hotter, more attractive ways to spend their time and capital.
Like gold and silver. Who
Yeah,
knew?
boomer rocks.
Who knew?
Yeah.
I mean, gold and silver, they've been in momentum trades before. Like we've seen that before, but
yeah.
All jokes aside.
What's really weird about gold and silver, though, is there is a huge divergence between the paper markets and the physical markets. So as I've been helping some families sell, and I've been, talking to different physical gold shops, either small mom and pop shops or larger shops or even refineries. The refineries a couple weeks ago in a lot of places like slammed the brakes on being able to accept silver. They were like, hey, this is out of hand. We have too much supply, or whatever their issues were. And a lot of physical gold and silver shops started offering like 30% below spot. So it almost felt like the paper markets were way too high and almost disconnected from reality. And maybe today we're seeing the reckoning of that, where the paper markets are actually playing catch up with what the physical shops are actually paying for. So maybe they know something we don't, but 30% down on silver today, and maybe that's why the shops are like, hey, I don't want to get caught holding the bag with all this silver that when I actually turn it into the refinery, they're going to give me 30% less. That's another thing that also drives the markets.
Kind of a sad story on the small business end of things with all of this gold stuff. She's a shop owner, custom jewelry, and she was saying that like her sales are down a ton because people aren't buying jewelry at these higher prices. And they say, what do they say? That's saying nothing cures high prices like high prices.
Yeah.
Or remember in the commodity saying that they have going around. And I don't know. It was just something that I wasn't thinking about. I wasn't thinking about like small custom jeweler shops that people just aren't buying their jewelry and they're not having great sales because of it.
Yeah, it makes sense. If you could have bought like a necklace for $1,000 a year ago and now it's 2,000 or 3,000, you're probably gonna be like, I'm gonna pump the brakes on that.
Yeah, I'm gonna wait on that because a couple of years ago it was way cheaper, and that'll probably come again.
Yeah,
maybe not. We'll see.
But again, I think, to your quote about what cures high prices is high prices. That's how it works in commodities. If it's, gas prices and oil prices back in 2008, when they went parabolic, to now the metal parabolic rip, or any commodity where when the price goes up, you can increase the supply, that causes these big boom and bust cycles. And that's why commodities historically, their CAGRs are just not that great. I mean, look at, natural gas had a really weird move over the last, week. It ripped, and then there was like a 40% gap overnight. Did you guys see that?
Mm-hmm.
Let me pull that up. I don't know what caused that gap down, Trav. Do you?
Well, the front month futures are also very volatile, and they're also subject to like roll changes. So when it rolls over to the next contract, and there's funky stuff too that like we saw when crude oil on the front month contract went negative, for a little bit there during COVID, like because of like things like storage costs and the technicalities of the contracts themselves, the price changes can look really weird if you're just looking at the front month contract. Mm-hmm. So typically you'd probably really want to focus on like something a couple months out when it comes to those futures for like those volatile energy contracts. But yeah, and gas has had some really interesting dynamics because in the short run you've had oversupply, but then it got like undersupplied for a couple of weeks based on the cold snap that hit the entire country. On the longer term side, now you've kind of got rising demand from AI data centers and from LNG facilities. So there's all these cross currents happening in gas that are making it very volatile, especially if you're looking at like shorter term price action. Mm-hmm. But gas has been a widowmaker overall for like 2 decades. It's like every time it pops, like more supply comes in quick, and we've generally been oversupplied in nat gas, at least in North America. Other places it's a little different, but yeah, gas is a really crazy one.
Yeah, and I guess this is just a good example of how with commodities, I kind of use like a trading range. It's not so much like up and to the right like you see with stocks or any compounder market like, Amazon over the last few decades, or Apple, right? It's like if you look at a multi-decade chart of Bitcoin or some of these like compounder charts that go up and to the right, you just don't see that with commodities. If it's energy or metals or whatever, like if you look at, let me just see if I can get the longer term, like spot silver price. I don't know what the longest chart. Yeah, here we go. Yeah. So let's look at a monthly chart of silver. You go back to the 70s, silver broke out above $6, went to like 45, and then crashed. That was, call it 1980, right? It did. And then in the early 2000s, it did the same thing. It went from $5 or $10 up to like 50, barely took out the prior high, and then crashed. That was 2011. And then it took over a decade to make a new high. And my expectation, unless something is fundamentally broken with the world and we're going through some de-fiat phase where silver is just going to stay higher for longer, my expectation is that this parabolic rip is going to do what it's done in past decades and pull back and then underperform for many, many years. So we'll see if that's true, but that's just how I think about commodities, that again, when the price goes higher, the supply goes higher. With Bitcoin, the supply goes high, or the demand goes higher and the price goes higher. The supply doesn't do anything different. It's predefined. And that's the first time in human history we've had an asset like that. So that's why I'm still bullish on Bitcoin over the long run. In the short term, hell, if we get a big bear market again, I'm going back into DCA mode. I'm going to dollar cost average when we're more than 50% off of all-time highs. Been doing that for more than a decade. I'm going to do that hopefully for the next decade plus.
It's fascinating to me how the longer term silver chart looks exactly like a cryptocurrency. Really big rips, really deep drawdowns, equivalent to Bitcoin, and between like 60% plus at times, right? And then just parabolic rips. It resembles a cryptocurrency to me. So I think that people need to remember that, because I feel like sometimes silver, I'll talk more about silver. Gold I still think is, good to own for the long run, and it's a little less volatile than the others. But I think that it's important to remember that when constructing a portfolio and people wanting to put, silver in, because a lot of people have been hot with silver and having really high allocations to it. And I just think it's important to remember that it seems innocent because it's silver, but it can really destroy you if you're not careful and you wait too high to it and you don't anticipate the volatility that it's historically brought to a portfolio. So
what do you guys think that here? I just pulled it up. What do you guys think is the 50-year CAGR for silver?
Ooh.
50 years.
I'm going to guess 2% annualized CAGR.
Nick?
5%?
Nick, you were closer because of this parabolic run.
Yeah,
it's about 6% going back.
That's why
50
I went up.
years. Yeah, but let's say before this year, before this parabolic rip, let's go back to January 2025. It was 4%. So
right.
Again, everybody likes to get focused on the short term and think about its recent, 3-4 month performance. But when you look over 50 years, you only made 6%. After inflation, that's nothing.
With insane volatility. Again, going back to your point on Sharpe ratios and the comparisons, it's like you got to know what you're investing in and how it's going to change your portfolio. And it seems like an innocent investment. Silver, sure, but it's pretty gnarly.
Yeah. All right.
Without the return potential of less risky assets.
Yeah.
Or even Bitcoin, which, higher volatility, but better returns.
So, okay. We've talked about metals. We've talked about Bitcoin. We've talked about inflation, which actually right now, just by the way, I pulled this up this morning. Trueflation, which I think is a much better indication of inflation, is barely above 1% right now. So assuming that's true, assuming that inflation is only, 1-ish %, Trav, what do you think this new Fed chair should be doing over the next year? Assuming inflation stays around this. And again, I think that we can look at the impossible situation, and does it even matter? But do you keep rates higher above inflation and create that list of issues, or do you cut rates and possibly even QE and debase by design?
Yeah, I mean, I think there is risk if you lower rates too much of reinflation, especially because right now US GDP growth is still pretty hot. You've got the AI investment. I mean, honestly, the other day, Meta's guidance for CapEx for 2026 was just unfathomable to me. They were doing 35 or 40 billion of CapEx 2 or 3 years ago, which looked pretty high. They did 70 last year, and they're going to do somewhere between 115 and 135. That's actually not a that's a fairly meaningful number relative to US GDP that they're going to spend in 1 year from one company on AI, right? So you've got, when you add up all the other players as well that are spending on AI right now, the amount of investment happening for both AI and kind of reshoring manufacturing this year is driving a pretty big economic boom. And so I know that like a lot of people, sentiment wise, consumer wise, it doesn't feel great, but GDP looks actually pretty hot. There's all this investment happening right now. I don't know if you put rates back at 1 or 2%, you're probably just going to shoot yourself in the foot and get yourself right back into a re-inflationary environment, which is going to end up driving rates up again and hurt housing and just start the cycle all over again. So they got to find, in my view, they got to find that point that's probably around the neutral, like maybe like 3% Fed funds rate, 2.5%, 3% Fed funds rate, maybe right around the overall. I mean, do you really believe 1.5%, 2% inflation? It feels like it's a little bit higher than that if you actually look at the categories and real life stuff like healthcare, inflation, and stuff like that. Plus, you're probably going to get a little bit more commodity inflation this year from what's happening in underlying commodities and copper and things like that. So I think neutral rate's probably closer to like 2 or 3%, and that's where they need to go. If they go too far below that, then you just risk shooting yourself in the foot. Long-term yields end up rising, right? Like the things get kind of like out of control again on the inflation front. And so it's counterproductive to go too low in my view. So I think like, I don't know, again, I think 2.5%, 3%, they could cut a couple times, like small cuts this year. There's other stuff they can do to kind of like make sure that mortgage spreads stay tight. They can try to incentivize supply and actually building more homes in the U.S. That would probably help things on the inflation front and on the housing front. And so I hope that they focus more on that instead of just trying to jack rates as low as possible. The other thing we got to think about is like, even though Kevin Warsh may be a Trump guy and he's coming in as chairman, like it's still a committee decision on what happens with rates. And so,
True.
That's something that will keep the Fed from perhaps going too crazy on rates. But yeah, I mean, it's not an easy job for them. It's really not. Yeah.
Okay. Good points. I know we're running short on time. Another big narrative that I want to talk about that, Trav, I know you've done some videos on talking about the AI bubble. And, you just mentioned Meta's massive spending for this year. Is most of that going to AI? And also like, what else are you seeing out there? And how does big tech play into this? I noticed that, the Mag 7 or 8, they're actually underperforming the S&P this year so far. We're just a month into it, but it is interesting to see large cap, specifically tech, kind of lagging. What's happening over there? And like, what are the cheap stocks? Where are you guys dumpster diving, if at all? And where's the opportunity in equities?
Man, it's crazy in stocks right now. You won't believe how many cheap stocks there are, and how many falling knives there are. And I've been buying some of those falling knives. An example would be software. The entire software sector is seeing a massive sell-off because fears that AI, now that it's getting so good with AI agents and just the AI models, that it's gonna it's too easy to create software. Existing software companies are gonna slow down or even see declines in market share, or too much competition takes market share from them. We wrote a piece for the Escape Velocity newsletter, Escape Velocity Investor newsletter, that people should go read if you want to go more in depth. But my view is some of that is like not necessarily going to be the case for some of these companies. Some of these software companies are actually going to be able to utilize AI and grow their businesses faster. But nonetheless, like the whole software sector is sold off massively. When it comes to So there's all these opportunities arising. There's even cheap stocks in areas like social media, Pinterest, Snapchat at new like multi-year lows. There's, stocks that were once growth darlings like Duolingo and Hims that have sold off like more than 50% in the last 6 months, right? So there's all these opportunities emerging. And on the flip side, you got Mag 7, which I thought even going into this year probably would underperform, mainly because of that AI investment is so significant. It's going to start to create a drag on earnings growth. Now Meta actually, even though I think it will be a drag on earnings growth for them this year, the stock popped because they were saying that even though we're going to spend this crazy amount of money, mostly on new AI data centers, we also think that revenue growth will accelerate. And so if that does happen, maybe Meta will be okay, but I still think there's a lot of risk there that revenue growth may take a while to catch up to the investments they're making. Microsoft had one of its biggest sell-offs in history after earnings, even though it was just a very slight deceleration of growth rate for their cloud computing business. Like investors wanted to see 40% growth in that business this year, and they guided to 37 or 38%. So it's You know,
Wow.
Do you think the market is just looking for a reason to panic, to think that the AI bubble's imploding? Or
yeah, for certainly that's true. And anything that gets labeled anywhere close to an AI loser, like look at Unity today. Unity, the company that has both a mobile advertising business and a game engine business, is down 20% today. It was a darling momentum stock. Now it's down 20% today because Google yesterday released a tool called Project Genie that can essentially create new virtual worlds with a prompt. And so all of a sudden now investors are worried, is Unity an AI loser all of a sudden because their game development engine is going to, lose share to these things? And so
it looks like my February calls are a zero on these. Damn it. I've been doing so good on the options games over the past few months. And
that was a nice breakout setup too. Bottoming breakout setup.
So annoying. Yeah. It was a multi-year accumulation range breakout, and it was absolutely a trap.
Damn it, AI.
Yeah.
So, but what is setting up here is interesting because Meta proves that the AI infrastructure boom is still on this year. Like, people are still going to worry about it. It's going to have big pullbacks this year because like the whole space has been so hot. And so AI infrastructure, I think, is just going to be really volatile and choppy, and you might be able to make money. But where I think the most opportunity is in all these companies where the market is just shooting them first and asking questions later and saying, AI loser maybe? Oh, boom, stock down 30, 40, 50% in a couple of months. Like, there's going to be the babies thrown out with the bathwater, so to speak. There already are. And so some of these stocks are getting so cheap. And so there's a lot of opportunity because some of those companies, again, like I said, are actually going to use AI to make their businesses better. Their margins are going to get better. And so, yeah, it's going to be interesting. So,
dude, I love that thesis so much. Like, to think that there is a cheap sector in this market with indices still around all-time highs. Like, that's awesome.
Oh yeah, there's so much dispersion right now because everyone's been chasing like metals and AI infra, and everything else in the market has just been pretty much hammered except for like a few smaller areas. But yeah, I mean, it's going to be a very interesting year in that regard. Like, stock picking and dispersion is just, it's creating so many opportunities. So we're really excited.
Nice, man.
Yeah.
Well, yeah. I know with people looking at a potential bear market in Bitcoin, market sentiments in the gutter, people are capitulating, all pissed off and angry. It's like, dude, keep something in mind. There is always another trade, always another opportunity, always another investment right around the corner. Like, unless you do something stupid and take yourself out of the game, there is always something else that you can do or an asset that you can use to grow wealth. And I think, to recap kind of what we talked about today, just talking about multiple time horizons. Yes, know the macro. Yes, know the issues with fiat. Yes, know what the Fed's doing, all that stuff. Those are long-term narratives. Also know the medium-term market cycles, momentum, and also don't get completely shaken out from the day-to-day emotional swings. And, there's just so much noise on the short term. And I think, Trav, that was our goal with the Escape Velocity Investor, is like, try to help people cut through the fire hose of information where 99% of it is noise. Like, how can we help people kind of distill that down into what is the signal? What's the shit you really want to pay attention to? And what's some of the stuff that you can maybe ignore?
Absolutely.
Cool. All right. Guys, what is coming up next week or maybe the next couple of weeks that you're looking out for? Nick, any other final points that you're seeing maybe with your clients, any tax stuff people should be thinking about, any financial planning things people should be thinking about?
I think we're going into, the quarter where we reevaluate allocations and see if we want to make any major changes in our portfolios. And going into being in 2026, I think that my mantra is value. I think many people are tired of how overvalued things have gotten, in certain areas of the market. I think people want to have good risk to reward on opportunities. And so I kind of mirror Travis's sentiment that now's the time to be scanning and, looking for great fundamental value out there and stocks that are just being completely ignored because everyone is chasing what's hot. And we know very well, we've been doing this a very long time. We know that those are the times where, you put your nose down and risk to reward matters. And now is the time where you really can make outsized returns by taking advantage of I don't want to say market participants being silly, but you take advantage of when people get too caught up in the momentum. And
Emotional
so,
overreactions.
thank
How
you.
about that?
Yeah, thank you. That's great. A great way to frame it. So that's what we've been looking at. Is I've been looking at reallocating, thinking about the stock market is still expected to do really well in 2026 in terms of growth. Like earnings growth expectations are in the double digits. Price targets for the S&P 500 are looking really good. I've seen like between 75 and 7,800 price targets, and it's kind of hard to put it all together, but there could be some tailwinds with tax refunds because of the tax law changes. So, maybe we do start to see more activity in the housing market, more activity in consumer discretionary. That's an area I'm always looking at is consumer discretionary is very cyclical, and it's been very out of favor. And a lot of times you can pick up really cheap, good companies in those moments. And that's how I've personally in my own portfolio made a lot of my own, wealth, is by playing those cycles. And so I'm paying attention to that again, and paying attention to trends. And just
to your
looking
point
for
about
value.
real estate. So, one thing that we were talking about in Austin during the pandemic was how crazy real estate prices went. They just did a full round trip. So basically, everybody was paying, we were talking about this on the show, and everybody was paying 6 figures over asking. There was like, I think it was a few thousand homes that closed in Austin where they had paid 6 figures over the freaking asking price. And we said, guys, how is this going to end? Not great. And
Not great.
we personally know people that got caught up in the bullshit and now they're underwater. But now that we are now right back to kind of baseline. Isn't that interesting? So I'm starting to think like, hey, is this now a better time to start to look at real estate, especially if rates start to come down more? Maybe real estate could get a boost.
I do think I was actually looking at real estate in Austin, and I was like, damn, this is much better. Like I was looking at homes and I was like, I would buy that. I would buy that. I would buy that. Like, I think that Austin is actually, it's a pretty good time to start looking at buying in the Austin market. I unfortunately know people that have been hit really hard that bought the top. They're foreclosing, they're short selling, they're, paying out the butt to try to keep their homes running. And it sucks to see that. And I've heard a lot of people that I've been talking to talk about how their home values have gone down. So, and they've been surprised about it. But yeah, that and the Florida market too, right? The markets that were hit the heaviest with gains, they're finally starting to come back down towards maybe this could be a good time to start buying. So does that kind of hold the economy up? We all know that the housing market is very important to the economy, and AI has been kind of holding things up. But maybe 2026 is the year of the consumer, the year of real estate, the year of, maybe more money in consumer pockets if inflation cools down, if rates give people a break on their mortgages. So we'll see. But I guess I'm kind of thinking of 2026 as like the comeback of the consumer potentially, if that makes sense. And the consumer's held up pretty damn well considering, but maybe we start to see even more improvement in 2026.
Cool. And one more question I had for you guys is, we have home bias, right? When it comes to stocks, we focus a lot on the US. Well, a lot of people might not even know that last year, international markets actually outperformed US markets. So like, for example, the FTSE was up 30 something percent last year and has just broken to a new all-time high. So the UK, the German indices, emerging markets, things like that. Like, do you guys think this is going to be another banner year? Should we focus more on that? Because I don't think over the past few years, we really put too much emphasis on emerging or international markets. Do you guys look at that as a missed opportunity or like it's okay? Or, how are you guys thinking about that?
I think, yeah, emerging markets are a real opportunity. I think a lot of, again, kind of goes back to one thing we were talking about earlier, like international investors are looking at the US going, policy is changing pretty quickly. We've kind of got someone that's trying to bully us around. The dollar's been a little bit weak. Like there's there's some reasons for international investors in particular to kind of reconsider allocations, maybe more away from the US, or, lighten up on some of those US heavy allocations, especially where they're like Mag 7 heavy. If the Mag 7, is underperforming and the currency's going against them, right? They start to look, maybe there's some better plays internationally. Plus, you've got higher international growth in the last 6 to 12 months in terms of GDP growth. This year forecasted as well to be a pretty good year for international growth. You've got more deficit spending happening in countries in the EU, for instance, and so you've got some more fiscal support in other areas. And you've got areas like China's stocks coming back to life. There's been some stimulus there. There's been some displays of like really good technology, right? And so there's a lot of reasons to maybe consider, even as a U.S. investor, should we be looking at some more international markets? Should we be looking at Europe or places in Asia, for example? Maybe in Latin America too, you've got some changes in power happening there. There could be some interesting plays. And so, yeah, I mean, ultimately, I think we're all probably underallocated to international, and we've got to give that a closer look to maybe see if there's some good places for exposure there.
Cool. Yeah. Even Korea has been going kind of parabolic.
Yep.
So yeah, I don't know. I'm going to keep focused on that. Obviously, we don't want to just chase this, but if there's, if there's good follow-on momentum stuff.
Yeah, Korea's a weird one too, because like it's really concentrated in some of the larger holdings like Samsung and SK Hynix, which have been going parabolic because of memory prices and because of AI. So it's a little bit AI memory tech heavy. And you can't really access individual stocks in South Korea as easily in the U.S. So it's kind of a weird one. But I do think all of Southeast Asia is kind of interesting. Maybe even a little bit of China exposure. I don't know. As a U.S. investor, it makes me nervous. But it's also like there's a lot of cheap stocks there. So
yeah, you've done really well with like Baba and stuff like that.
Yeah, dipping my toe in the water with call options and then getting out with gains and stepping back in a couple times. So maybe we'll do that again this year.
Yeah.
Yeah. But
cool. Well, we covered a lot, man.
Yeah. It's going to be another big week next week. We got a heavy earnings slate again, Google, you got Amazon, Google, you've got, geopolitical stuff happening. You've got, lots still happening, of course, with the momentum trade and the metal sell-off. It's going to be another crazy week next week.
Yeah. How have the vibes been with earnings so far? Nikki, I know you said projections are still looking really strong. What have the actual results this week kind of shaken out to look like?
I mean, from what the companies that I've tracked, and I also track the Mag 7s, it's been a little bit of a mixed bag, to be honest. There's been some big beats, like you look at like a SanDisk or Seagate, which like had crazy earnings beats, and we're going up parabolic. You've had some pretty good results out of some of the industrial players. But then you've had some mixed bags, like in the Mag 7, like you had Tesla's numbers were weak, but the stock, went up because people are excited about robots and maybe merging with SpaceX. you had Meta go up, and Microsoft go down, so it's kind of been, ServiceNow had really good results, but the stock was down because it's in the software sector and everybody hates software. It's been a very funky earnings season where I think generally the numbers have been pretty good, but the reactions have been much more mixed.
Cool.
Yep. Sounds like opportunity to me.
Oh yeah.
Yeah.
Absolutely.
I mean, I love the fact that there is some stuff that's just beat to death while the indices are still floating around all-time highs. Like that gets me excited. And, also the potential for like deeper prices in Bitcoin. I've got a short hedge on right now, but we'll see if we break down to the next key level, which I think is around 75K. So I'm just watching price action. This weekend will be interesting. If we get any weird gaps this weekend, trying to front run Monday, I don't know, but we'll be in the Discord for the wealth building community. We're going to also be working on more deep dives for the Escape Velocity Investor newsletter. That's a mouthful. But guys, if you got value out of this, hey, like it up, share it with somebody who you think could get value from it. Subscribe to the YouTube channel. And any final thoughts, guys, or want to wrap it up there?
Let's wrap it.
No, let's wrap it. I think we said all we can for now.
Yeah.
Okay. I know we packed a lot into this one. It's been a minute. So guys, thanks for watching. We appreciate you, and we'll see you next time.
Cheers.
Cheers.